Hello, and welcome to This Week in Review. This weekly segment is designed to highlight a few important developments you may have missed this week, what they mean for markets, and more importantly, the potential impact for investors. Now, let's review what happened this week. First up, the U.S. debt downgrade. Last week, Moody's downgraded U.S. national debt credit rating by one notch from its coveted AAA status, citing the growing national debt and rising interest costs. It caught plenty of headlines, leaving many investors wondering if the move might spell trouble for the markets. But to us, that's not the case. On the day of the downgrade, stocks initially dipped, but by the close, they managed to recover into slightly positive territory. Not the kind of reaction you'd expect if markets viewed this move as a major red flag. And this downgrade wasn't really a surprise. Back in November 2023, Moody's lowered its outlook for U.S. debt, giving markets ample time to price in the news. Plus, Moody's was the last of the major credit rating agencies to act. S&P downgraded the U.S. in 2011 after a contentious debt ceiling standoff, and Fitch followed in 2023. Those downgrades didn't derail markets then, and there's little evidence suggesting that this one will either. Credit ratings really have a rather limited influence on markets. They're opinions based on widely known information. What markets really care about is whether the U.S. can meet its debt obligations. And looking at the numbers, America's ability to service its debt is on solid ground. Debt servicing costs relative to government revenues remain manageable and are in line with historical levels that we saw back in the 80s and the 90s, a very strong period for stocks. And looking at bond yields, if credit risk were in fact a concern, we'd expect to see a sharp spike in yields. However, Treasury yields have stayed within a fairly tight range since 2022. And the few fluctuations we've seen this year are more reflective of sentiment-fueled swings rather than deteriorating fundamentals. Now, of course, rising deficits could become an issue over time if left unchecked. But as it stands today, the U.S. is comfortably handling its debt obligations, which is the core measure of its creditworthiness. Next, global flash PMIs. On Thursday, we got a fresh look at global economic activity with S&P Global releasing May flash purchasing managers indexes for the U.S., the Eurozone, and Japan. PMIs can provide a snapshot of how businesses are doing, and with recession fears elevated, these readings can offer helpful context to investors. What does the data tell us? Well, this month, the composite PMIs, which combine manufacturing and services, indicated expansion in the U.S. and contraction in the Eurozone and Japan. In the U.S., manufacturing and services PMIs beat forecasts, with more than half of respondents seeing growth, while data from the Eurozone and Japan were mixed. Importantly, the overall global composite PMI, which aggregates results for around 40 countries, remained expansionary. A helpful reminder that despite recession fears and sour sentiment, the global economy continues to churn along. Finally, Bitcoin. Earlier this week, Bitcoin hit an all-time new high. Its performance this year has fueled some debate amongst investors as whether Bitcoin or other cryptocurrencies should be a part of their investment strategy. Some argue diversification means you should spread your money around as many asset classes as possible. However, rather than taking a kitchen sink approach, we think it's best to blend assets with long-term risk and return profiles that best fit your goals, cash flow needs, investment time horizon, comfort with temporary declines, and other personal factors. While diversification is important, Bitcoin's risk and return profiles are largely unknown. Unlike stocks and other assets, we don't have much historical data to understand how Bitcoin may perform under various market conditions. That makes it hard to confidently anticipate where Bitcoin may be headed. And when it comes to volatility, Bitcoin is far more volatile than stocks. Since 2017, Bitcoin has experienced over 190 separate negative 5% single-day declines, compared to just 6 days of similar magnitude declines for U.S. stocks. To us, Bitcoin and other cryptocurrencies behave more like speculative commodities, similar to gold, than traditional investments, given their comparatively high volatility. They're also just very difficult to time. While we don't rule out any investment option entirely, we believe stocks and bonds are better suited to meet most investors' long-term financial goals than alternative investments like Bitcoin. Thank you for tuning in to This Week in Review. If you're looking for more insights, then don't miss our other series, 3 Things You Need to Know This Week. It's released every Monday. You can also visit FisherInvestments.com anytime for our latest thoughts on markets. Thanks again for joining, and don't forget to hit like and subscribe.